briefly, I really have a panel of experts here, really esteemed panelists. We have, and obviously I'm going to butcher their names, there's no denying that, so apologies up front. Brenda Kithinji? Not too bad. But Brenda is a principal banker with the European Bank for Reconstruction and Development. I have Mncedisi, Dumse?
Mncedisi, Dumse.
I'm not even going to try that one. Who's the Senior Vice President of Real Estate Finance for East Africa with Standard Bank. And we have Bangwani, Maphophe. See, butchered it. Who's a banker, real estate, East Africa region with Absa Bank. So we have three top institutional finances, two very Africa-centric, or not really. Standard Bank has just moved out everywhere else. And then obviously from the European side of things. Now, we always have a difficulty in retail finance because the bankers believe that they enable retail development and retail transactions. And us guys right at the end of the wheel sometimes think they disable and they make life very difficult. So I'm going to task our panelists this morning, and I'm going to start with Bangwani and ask you that what are the most important considerations involved in financing retail assets, whether it be development asset or a purchase of an operating asset? No. Try this one.
Cool. Thanks for that. So I think, let me first give a little bit of context of who we are as banks, right? So we are a financial institution, and what that means is we effectively raise capital and deploy it into various assets, for example, such as loans into real estate projects. And with that comes a lot of responsibility because of the kind of capital that we do raise. So it's your deposits from ourselves, and because of that, we actually don't have a lot of room to lose money, and therefore we're very careful in our considerations and how we make decisions. And then the second bit of context that I need to bring in is that from our perspective, when an equity investor succeeds, we as the debt capital provider are succeeding as well. So we're always on the same side. So it's very important to just bring that into the room. And some of the important considerations we make is with all that context. So for example, if there's a new development, new asset, the most important thing, I think, is the management capability and expertise, because that drives everything into the investment. The kind of decisions are made from the point of developing, procurement, and the kind of management around construction risk. And then post-development, it's very important to see how client is foreseeing how that asset works, the tenants will have in the property, if there's any competitive pressure that they might face. And I think it's also important how the capital structure is set up, because from our perspective, if your debt is rightly sized, then how your property, builds up occupancy, it can probably withstand a lot of downside risk. Whereas if there's too much leverage or too much pressure on the debt, then there's less room for error. So it's very important to bring all of that into context, yeah.
Thank you very much. I'm going to come back to you on that management structure. I'm first going to let you guys do the nice platitudes, and then we're going to come back and ask you some questions on that. Mncedisi, you've been involved now in funding some of the larger projects from Stanbic, the larger retail projects, specifically in Uganda, for a period of time. Development projects on Acacia Mall was one of them, right at its inception. But what have you seen that has basically changed trends in the retail sector that have aided and abetted bankability over the last 4 or 5 years?
Thanks, Marc, for that question. I mean, that's a very good question in terms of the trends that we see, and that's aiding and supporting, I guess, the growth and the ability for institutions to participate. So, I mean, one of the factors that have changed, not just in Uganda, an example, but across the board is, as my colleague mentioned, when you start looking at an asset, you have to understand its cash flows, and you need to be able to support it and matching that to stabilize it. But outside of, I guess, the bankability, all of that, fundamentals such as location haven't changed, but sizes have changed, right? So as we move into different generations, what we've noticed is as digital trends start to pick up and people start to go for convenience, retail centers now have to talk to experience, right? So retail will still always be an important factor within the economy, but now the retail doesn't have to be as big, or if it's going to be big, you need to be able to stage it so that within its location and within its precinct, it follows the natural growth and its trajectory. And we're starting to see those considerations come on board where mixed-use developments are quite critical, where your retail comes, your residential needs to follow, and so does your business. The younger generation are all about experience and convenience, so they want to be close, and it has to speak to the experience and the flow of the center, so even your tenant mix becomes very critical and quite important. Even your tenant mix becomes quite critical and quite important when you're considering a retail center. It has to complement and work with itself, so your anchor store remains important, your pharmacies and the likes. All of those considerations are shifting how you would look at retail projects.
Thank you for that, Mncedisi. I'd just like to, our last panelist has arrived. It's Mr. Evans Brown, and he is the group's product, I think I've got it right here, Group Head of Products for I&M Bank. Welcome. Brenda, if I can move on to you. The European Bank established its Kenya office in 2025, so I think it's still early days for you guys. Retail, is it something that you'll be looking to invest or fund into down the line? And what are your thoughts on the retail climate within East Africa and specific to Kenya?
Thanks. Yeah, so I mean, EBRD established our offices here in Sub-Sahara last year. So we're in 6 countries now. So in East and Southern, it's Kenya. The rest are West Africa, so Cote d'Ivoire, Senegal, Ghana, Nigeria, and Benin. And, you know, we offer sort of products across all the subsectors, so real estate being one, across all of them, commercial, retail, housing, industrial, data centers, and any other alternative assets. And so, yes, we're very much interested in the retail sector, more around development. And I think the way the institution is looking at it is that there's still a lot of supply gaps across East Africa in retail, and there's still opportunity for us to sort of increase formal retail in this part of the world. And so the bank is quite interested in funding retail assets. And I think DC and Bangwani spoke to what the fundamentals are. So still looking at, depending on the catchment areas, could be smaller size, could be larger size retail with experience. But I think one of the things that I think we've noticed, I've been in banking as well with the two of them, is that sort of large-sized malls have struggled. And, you know, in the region, especially in Kenya, where there's quite a lot of supply, there's funding assets on the basis of sort of aspiration and indicative interest. That era is sort of ending. And so there's a need for proven developer track record. There's a need for firm commitments from anchor tenants, experience, strong fundamentals in terms of cash flows that can be resilient even in a stress-tested environment. That's very important. And I think, like they said, construction risks being well mitigated is also quite important. Yeah.
Thank you. It's interesting to note, and we will take cognizance of the fact that you guys want to fund retail. We'll be knocking on your door. I did say earlier on, and sorry, I'm always going to stir the pot. I did say earlier on that Acacia Mall in its development phase was funded by Standard Bank. I can say the funding now sits with Absa Bank. So I hope the two of you are not going to end up in blows on the stage. Eh? Fight with me, not with each other. Evans, there's this term that's thrown around, bankability. We will fund, or we will finance, let me put it that way rather than fund. We will finance retail, but it's got to be a bankable transaction. Can you explain to us fools what bankability means?
Thank you so much for that question, Marc. Apologies, I got into some call. Sorry for coming in a bit minutes late. Before I just talk about bankability, I want to try to put it in the Kenyan context on the journey that we've been up to pretty much where we are today. We started off, where, the 90s, where we could only give mortgage to, we call them the high net worth and, government, officials and, government staff who by then would say we're doing much well. The banking was more concentrated around, high-end towns. And that has evolved, over time. And today we have, in Kenya, we have, a county where we are opening up various, towns just to ensure we open more opportunities, building hospital, universities across all the counties. And that's open in terms of now business opportunity. If you look at Kenya also in terms of, what we say that those who are, apologies, the microphone does not, but yeah, we'll take it on. If you look at, the way this has shifted, because we have now moved away from, those, specific or targeted income earners to now the surge in the youth, the surge into various, sectors. There's a bit of focus on MSME and there are so many middle class that have grown. The middle class that I would say earning between 70,000 and Kenya and 150,000 have actually grown in leaps and bounds. And then also, so previously there was a bit of difficulty in terms of accessing these finances, especially for the retail class, because of the high interest rate and the stretched repayment from a mortgage perspective, and also looking at the income. And right now, many things have evolved, especially in Kenya, where we have, banks have become more creative, coming up with 105 financing. So what that means is that beyond the property that you're purchasing, you can be financed 100% plus additional 5% to take care of, those other costs that are surrounding that. And then the others, partnership, in Kenya we have Kenya Mortgage Refinance Company that has actually made it much easier and affordable for the middle class and the retail to actually access some of this. So with 10.5 million, if you're entering, then you're able to access funds. So with that landscape and the picture that I painted, I would say bankable retail has actually expanded a little. From now a previously constrained repayment to now a more affordable, because affordable does not mean cheap. It means you're able to get a property within your income level and be able to service it with comfort. Developers have become more creative. We are seeing houses as low as 2.5 million, 3.5 million. What that means is that more Kenyans can actually access some of these properties. Now, from a banking perspective, we look at a number of things. So we look at, the developer, the property where it's located. We look at, the repayment, of the purchaser of the property. We're also looking at the exit because you also have to consider in case, there are many factors that could also result into exit, then that comes into that. So I believe that answers the question. Thank you.
Thank you. It's quite interesting that when one talks about bankability in shopping centers, etc., we're looking at covenants, we're looking at the land location, we're looking at the timing. I mean, earlier on you were saying that you mentioned generally your retail will come and then your residential will come around it. Very much a South African context, if you can think about it historically in South Africa, and you can go through each city, each node in South Africa. Developers have gone and built shopping centers, prior to the demographic density actually happening around. You think of the likes of Greenstone Hill, Northgate, et cetera, and we can go through hundreds of them. In the East African market, it's a little bit more difficult because your arterial routes and structures and that sort of thing don't really exist in these new sort of areas. You're finding a lot of redevelopment of previous areas. But why I'm going around with this whole thing, we were speaking earlier on about financing historically was ultra high net worth individuals. You were speaking earlier on about how the management infrastructure is so important around these developments. And then thirdly, you were saying a lot of these larger developments have not necessarily succeeded in the East African market. If I could put it to all four of you as bankers, just a short answer. We have a perception or belief as managing agents that the banks are too involved in financing based on developers' balance sheet rather than bankability of the product. So what happens is I have nothing. I have a great location, I have an option on the land, I have an 80% blue chip pre-let. I can't get finance because I don't have 20 or 30% to put down. Ultra high net worth individuals that have generally made their money in other businesses want one of those, and they come into the market and the banks will finance them, but they are too actively involved without understanding and having the experience of what a proper shopping center needs to be successful down the line. And that has created risk in the market, and it's created both financiers and retailers to lose appetite to develop. Am I right or am I wrong? All four of you, starting at the end.
Cool. Thanks for the difficult question. So I think, to be honest, it is a spectrum. And remember what I said in the beginning about context of being a financial institution and the responsibility you hold. It's a spectrum in that you could go from funding a startup venture capital kind of funding versus a well-established institution. And of course, if you're skewing more towards the startup, limited capital, then in my opinion, it becomes less appetite for banks because we're just not set up that way. Whereas you'll see most of our exposure is skewed towards the institutional, well-established, proven models, just because of the way our capital is set up. It's not to say that we'll never look at more risky deals, but I think what's important there is how you mitigate that risk. And if you imagine downside scenarios, how you manage that risk, and whether the management scenarios are reasonable for us to accept that risk. So I think, from my perspective, it's more about making the risk acceptable, even if it starts high, sort of from the point of request to mitigating it to an acceptable level. I think that's the magic, that's the trick with how you do that. But we do have a lot of appetite in seeing new development and making it contribute to the overall micro and macroeconomy of the markets that we operate in. And I think retail is a good example of that, in that developers can see the difference that those investments make in people's lives, and that sort of thing does excite us, but we need to manage it according to acceptable levels of risk. Yeah.
I think we're a little bit different. I mean, we're a bank, and 80% of what we do is debt, but we also do some equity, and so we can take on a bit of risk in that regard. And so I think at the center of it is the fundamentals. So if you have the right fundamentals that you've spoken to, so then the project is bankable. So the issue we're dealing with is a sponsor who probably doesn't have as much track record. So what I would say to that sponsor is two things: partner with a high net worth individual, find someone else to get equity if you can do it yourself, and then or also just have a portfolio of assets and sort of try and create not just a single asset, because it will be difficult to have someone come in and find equity on a single asset, because the question will be around exit. So as much as we would do equity would still have the question around how will we exit this asset. I mean, it having good fundamentals is a good point, but then if we have a portfolio of assets and we can come and fund a portfolio of development that you will be doing, and you've sort of brought along or tagged along the high net worth individuals or other developers that have track record, then now you have a bankable platform. So it's not just enough to have a bankable asset, but it's good to have a bankable platform that then you can sort of now crowdfund other equity players and build a good credibility story around what you're trying to do. Yeah.
Thank you. Steve?
Can I say what they said? So, yeah, as you mentioned, we did have this briefly, and I think, I'm going to touch on a couple of things I've already said, right? So we have the responsibility to get the capital out and back in, right, to enable these sectors. So what's quite important is we come in as banks, and the exposure that we have and the breadth that we have, we also have client base, right? So we enable the development of projects where if somebody comes with a tangible and a bankable asset but lacks balance sheet, we create strategic partnerships to be able to. So not only deploy equity, but also create partnerships, because the only way you will ever get your capital back is if you back a jockey with experience, right? So if your fundamentals stack up and you got the experience but you don't have the balance sheet, we could create those partnerships to support it. But if you have the balance sheet but no experience, that doesn't also traditionally mean that the solution is bankable, because the jockey still matters. I always say, in my earlier days of banking, if you have two people asking for $1,000, one doesn't have a job, the other one does. Who would you borrow the $1,000 to? The one who's got the capacity to bring it back. But that doesn't mean you wouldn't give the other one an opportunity if you can create that income for them to be able to pay you back. So that's quite critical in supporting, I guess, an opportunity of that nature.
Thank you. Thank you for that.
So for me, this goes just beyond the project. We're looking at the POC, the use cases, that these developments are meant. What are they looking at? So, for example, if we see there's, viability in terms of the off-takers based on now the particular project, then the risk framework is basically based on now, how will we ensure that, work with these, partners to ensure that, the targeted, off-takers are able to, take those properties. So I would say beyond now what my colleagues have said is that it's always good that we look at it not just from a project perspective, but also what is the targeted opportunity and how is that use case basically working to solve that particular problem, and how is that a need, at the current. Then we, based on that risk framework, then we're able to work, with those specific developers. Thank you.
Thank you. My next question goes specifically to our Absa and Standard Bank clients who have a record of investing in larger format shopping centers within East Africa. What has your track record and history exposed? What are the limitations? Where have the problems come from that have created and caused the failures?
I'll take a first shot at it. So, having funded large projects and seen, and to your point, what pitfalls or challenges they've come across, one is building too big too soon. Sometimes staging is quite important. It's also the tenant mix is also quite critical, and the right tenant, right? So you could have the right mix, but not the right brand. That we've seen. An example, I don't want to say the name of the entity, there's a lot of retail clothing brands that leave SA, you bring it to the market, and they want to sell what they sell in SA here without understanding the market. So when I say the tenant mix has to suit the location, that's quite critical. And the other one is, then we talked about the cash flows, right? If there's a mismatch between your lending currency and your collection currency, there's a lot of risk in that if there's no ability to index. So those are the experiences that we've gone through and learned to improve. Not to say that you walk away from an opportunity, it's just now you have the real conversation on how you make that opportunity work with that experience.
Yeah, I think to add to that, I think keep going back, but also management, how they engage with you as a lender, as a funder, how they engage with other stakeholders, such as tenants, the funders, it's very important to have honest and transparent management who, when they pick up issues, they disclose early on so that we can all manage appropriately. And I think from the property side as well is, getting feedback from tenants about their experience. So I think that obsession with the consumer experience is very, very important. So if that is ignored for too long, it can create fundamental issues that do impact your investment. And I think sometimes things out of management's control does happen. So for example, a tenant that is headquartered in South Africa or elsewhere decides to exit a market, even if that tenant was doing okay in that specific project, something that the investor necessarily can't do anything about, but your ability to adapt to that situation says a lot about your ability to see your investment successful for the long term. And I think what you pay is also very important. So if you're buying from someone who developed it, but you pay too much, that can drag you for a very long time. And it starts showing in how you manage, your basics, like your debt and your expenses, etc. Because you start being under pressure if you pay too much for an asset. And then, I think those are the things that we've seen here.
Sorry, Marc, do you mind if I add just 2 points? So I think one other thing maybe I'd add is ensuring that your sponsors are well capitalized. So some of the sponsors struggled from being well capitalized from an equity perspective, and so maintenance of the asset, struggled, and with struggling maintenance of the asset, then the experience is poor, and then from a sustainability perspective, then the retail center then struggles from that perspective. And I think also one other thing that sometimes bankers can maybe underrate is property management, having a good property management plan, having strong property management to ensure that customer experience is positive is quite critical.
Thank you for that, and I will put a little plug to that now. You've heard about property management. We're talking shopping centers. There's a big differentiation between retail management and property management. And I'll have a little plug again. It's very important that you've heard management is important, both from the stakeholder, the financial institution, and the retailer. And I think that is where the difference comes in retail management. Having a good retail manager who actually understands the market, who has the ability to educate the retailer. We see too many international retailers, whether it be out of the South African context, the Middle East, or even Europe or North Africa, enter the East African market with a cut, copy, paste model from their home markets. They don't understand the local demographic, they don't understand the local market, and it has a negative impact on the shopping centers down the line. Letting of shopping centers is not letting of commercial industrial space. It's an expertise that's founded on data and understanding the market, and the longevity and the sustainability of a shopping center is critically based on your retail management company, whether it be in-house or out of house. Knight Frank is a good one for those of you out there, but I didn't say that. Lastly, I know Murray's busy showing me fingers. Fortunately, they're that way and not the other way around, but just running through all 4 quickly. You're all in real estate financing, funding. There are the different asset classes: industrial, commercial, hospitality, residential, retail. Firstly, just off the cuff, which is your best to finance?
So I think, okay, let me put a spin to that. So
No, there's no, you answer, that's it. You got a 1 second answer.
So I think whichever asset class, the more defensive assets. So in retail, more convenience. Student accommodation, residential, especially in a Kenyan context where it's a rental market. Those are very exciting. And then industrial, if you get it right. So yeah, so there's context to everything, I guess.
I mean, we haven't yet done anything yet, so I would say everything. But I think anything that's institutional grade, anything that's high quality across all assets, we would do.
a portfolio of all of them. I mean, yeah, to my colleagues, I mean, the fundamentals have to stack up. It just has to be both right in the right place, in the right.
Yeah, Mike doesn't like that.
Yeah, I mean, if it's built right with the right fundamentals, I won't go through that. We've talked about it. Each asset has its place.
So all asset classes, I would say, we consider, and of course we look at each use case, differently. As I said earlier, the proof of concept, what that asset class is looking for to resolve. But of course, I know there's big opportunity around the retail space because there's a spreading of risk, and many other factors that are also considered. Yeah, thank you.
The reason I asked that question is we all, if you listen to everybody speaking, the bankers that we have here, they were all talking about the exit strategy. In everything that they look at is what is the exit strategy. The reality is, if you look at yields and returns, there is no asset in the property aspect that can show the return that retail can show, if it's successful, between years 8 and 20. And that is where the mind shift change we have to create that mind shift change into our bankers. But thank you, gentlemen. Thank you, ma'am. I hope you guys have enjoyed it. And if there are any questions for the esteemed panel, I think we've got a minute or two, Murray. Bankers are not going to ask bankers questions. All right, thank you very much.